Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 15th of October. So the economic calendar is void of any major economic news today. But as we move towards the latter parts of the week, we can see that we have UK CPI coming up on Wednesday. On Thursday, we have the retail sales data from the US, as well as a rate decision from the European Central Bank. Friday's data highlights will include some important data from China. Now, China has been in the news of late, with the markets there rallying aggressively in the latter parts of September because of optimism about stimulus there. But at the weekend, the finance ministry provided very little detail about the stimulus measures, which was a bit of a disappointment, causing the Chinese markets to drop. And we've seen the impact of that on crude oil prices and some other commodity prices like copper. The drop in the Chinese equity markets can be seen here on the Hang Seng, but the China A50 index has also dropped as a result of that. Markets linked to China have also struggled. For example, the UK 100, which has been stuck in a rather ugly consolidation ever since it hit a record high back in May. The German DAX index has also started to ease off its record highs today, as you can see. This is a potential warning sign that the rally could be running out of steam, but so far we haven't seen the breakdown of any major key support areas to suggest that the top is in. So the key level to watch on the downside include 19,495, which was previously resistance back in September before we broke above it earlier this week. So the technical trend will remain bullish on the DAX for as long as we don't see the breakdown of these higher highs and higher lows. The most recent low comes in at 18,905, which was hit early this month. So a potential break below that level would be a bearish development, and we'll cross that bridge if and when we get there. But for now, the market is trading at record highs, so we can't be bearish on this market yet, even if the index is looking quite overbought. Now in the US, we've seen the banks report earnings results, and so far they've been good. The S&P 500 has risen to a new record high yesterday, but today it has paused there and unable so far to add on to those gains. The S&P is trading at levels that have not been hit before, causing the relative strength index to reach overbought levels, as you can see on this daily time frame. As I remove this RSI-based MA, the RSI has now reached 70 threshold once again, where the index tends to slow down every time it gets there, as you can see in the past as well. Will we see a bit of a pullback from here? Remains to be seen, but the trend is clearly bullish, and we prefer looking for bullish setups at support rather than looking for bearish setups at resistance. That being said, always watch out for a potential reversal pattern, especially as we near the US presidential elections, which are now about 3 weeks away. So that risk could see the markets pull back a little bit because the RSI is not only overbought on the daily time frame, but if you look at across the longer term charts like the weekly and the monthly, you can see that on these time frames too, the RSI is at extreme levels. Here on the weekly chart, you can see it's approaching 70 again, following a 5-week rally, and the monthly chart is looking even more overbought, above the 75 level now, I think, or thereabouts, following a 6-month rally. In terms of support levels to watch on the S&P 500, this level right here at 5,773 is an interesting level to watch. Below that, we have the shaded blue area where the index had previously found resistance back in July and a couple of times in September before we broke above it, which later then turned into support, leading to a fresh rally. So if and when the market were to break below that area in the coming weeks, then at that point I would turn bearish on this market. But for as long as the series of higher highs and higher lows remain intact, the path of least resistance remains to the upside. Now here's a weekly chart of gold. As you can see by the shape of the candles here, the precious metal hasn't gone anywhere fast in the last couple of weeks, but it maintains itself just beneath the all-time high that was hit last month at 2,685, supported above the 2,600 support level and this bullish trend line that has been in place since the turn of the year, basically. So the path of least resistance on gold is clearly to the upside, but like the equity markets, the precious metal is looking quite extremely overbought, with the RSI on the weekly time frame being above 75, which is a level not seen since around April time, when we saw the precious metal stage a multi-week consolidation. So could we see a similar pattern moving ahead? That's the key question. On the monthly time frame, gold is looking even more overbought at 80 on the RSI indicator, above 80 in fact now. The precious metal has been hitting repeated new all-time highs almost every month this year, which has been one of its strongest ever performance. So with this backdrop, you can't be quite bearish on gold yet, but do watch out for a potential reversal, or at least a short-term pullback in the coming days, given these extremely overbought levels, which need to be addressed at some point down the line. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.